Ladies and gentlemen, next up we will listen to the updated information on normalizing policy to ensure a smooth takeoff by Dr. Sethaput Suthiwartnarueput, Governor of Bank of Thailand. Dr. Sethaput Suthiwartnarueput is the 24th Governor of the Bank of Thailand. He is also the board member of the National Economic and Social Development Council, the Securities and Exchange Commission, and the Insurance Commission. He has extensive experience in economic, policy, and financial markets. So ladies and gentlemen, please join me in welcoming Dr. Sethaput Suthiwartnarueput on the stage, please.
Your Excellency, Finance Minister Dr. Akom, Chairman Dr. Prasan, President Dr. Pakon, distinguished guests. First, let me thank the Stock Exchange of Thailand for having me here today. The theme of today's Thailand Focus is the new hope. But before we can get to the new hope and the new promised land, we need to make sure that the economy recovers. And that's where I'd like to focus my talk today. So let me start off with our policy objective. Our policy objective has been and continues to be trying to ensure a smooth takeoff. And I think this is important to understand because the policy objective in countries like Thailand is different from the policy objective that we see in the industrial economies. There, the issue is less one of trying to ensure a smooth takeoff, but more one of trying to ensure a smooth or soft landing. But we are at a different part of the economic cycle. So the economic conditions are different, and therefore the policy response that is appropriate in Thailand, as it is in the other countries, is different. So we go back and think about our objective now, trying to make sure that that takeoff is smooth and it continues, and ask ourselves, well, what is needed for us to get there? And to understand that, think about what kinds of things would prevent that smooth takeoff from happening. First off, obviously, if we manage to not be able to keep inflation under control. So trying to keep inflation under control is a key objective for us to get for the obvious reasons. If inflation starts to spike up, household purchasing power gets undercut, the boost to domestic demand that we've been seeing wouldn't happen. If inflation expectations get unanchored and we move to a higher inflation regime, all the usual bad stuff that we know would happen. So I don't want to preach to the choir here, so I'll skip on that point. The second thing that we need to do to make sure that the recovery is intact and we get that smooth takeoff is to make sure that the financial system continues to function well, that it continues to support the recovery. And on this, I think we've been quite successful in the past during the COVID crisis in trying to ensure that the credit system is functioning as close to normal as could be expected. And we've seen, for example, credit growth in Thailand, even during COVID, in terms of the growth rates, compare quite favorably to those pre-COVID, except for certain pockets which were underserved, and such as SMEs, and that's why we needed to have targeted measures to support them. But obviously, trying to ensure that the financial system continues to support the recovery is important, and therefore, again, that will dictate, right, the pace of normalization that we would like to see. So given that we need to get inflation under control, keep the financial system continuing to function well, right, the task now is to try to normalize policy. Because during the COVID crisis in Thailand, as with in many other countries, the authorities went, in a sense, all in, right? Policy rates were kept very, very low, extremely low, super accommodative, and financial measures were put in place to try to mitigate the worst of the impacts. So large kind of blanket type, broad type measures were put in place. And obviously keeping those kinds of measures in place for too long creates a lot of unintended consequences, moral hazard, and all sorts of problems. So it's not appropriate to allow those to be in place for too long a time. And that therefore now, right, the shift needs to be towards exiting some of that stuff and trying to normalize policy. The question is, well, how do we normalize policy? How do we get there? What pace, right? And there are a couple of guidelines for our policy normalization, which I'd like to share with you. First is we need to take a holistic and integrated approach between both monetary and financial policy normalization. So just to give you a quick example, on financial policies, during the COVID crisis, we reduced our deposit levy by 23 basis points, the FIDF fee. There was a recent decision by our Financial Institutions Policy Committee to stop that policy, and so that levy will be imposed again at the end of this year. That obviously will have an impact in terms of banks' cost of funds and will be passed through to the economy. So taking into account those kinds of effects when designing and thinking about monetary policy normalization will be important. So that's an example, again, of trying to take a coordinated, integrated approach towards normalizing both monetary policy and financial measures that we undertook during the crisis. Second point is the important one, and I'll focus a lot of my comments on this issue, which is that the pace, right, of normalization will be gradual and measured. Okay. On the financial front, what does that mean? That means that all those measures that we went kind of all in at the beginning of the crisis, right, those blanket type measures, well, we're withdrawing that stuff and moving and leaving in place more targeted kinds of measures. When the crisis struck, Thailand, as with many countries, again, undertook these broad blanket type measures, debt moratoria, right, restrictions on dividend policies and whatnot to try to alleviate the worst of the crisis. Well, again, given that the crisis turned out to be much longer than people expected, and the recovery would take longer, those kinds of broad blanket type measures don't make much sense, and a more targeted approach would make sense. So what we're doing is we're withdrawing a lot, have been in the process of withdrawing those kinds of blanket type supports, but leaving in place those targeted measures that are necessary. Why? Because the recovery in Thailand, as in other countries, has been quite uneven. So some sectors have been lagging, and there are vulnerable groups that are in place. So the kind of targeted measures that we'll be leaving in place include, for example, the soft loan or targeted SME credit scheme, which we'll leave in place until at least April of next year. We have an asset warehousing scheme to help support particularly firms in say, the hotel sector. That scheme will also be put in place at least until April of next year. And we have, very importantly, our September 3rd debt restructuring, long-term debt restructuring scheme, which provides regular incentives for banks to engage in debt restructuring. That we will put in place until at least the end of next year. And I use the term at least again because we will continue to be flexible and pragmatic. If conditions then warrant that we extend those measures and those schemes, we will do so. On the monetary front, what does gradual and measured means? Now, gradual and measured were terms that we put into the latest MPC statement for those of you who took the time to read it. And I'd like to spend a little bit of time just clarifying exactly what is meant by that and unpacking that term. First point to mention is gradual and measured are two different things. We weren't just looking for synonyms for the sake of synonyms, right? Gradual means one thing in our context and measured means another. Well, what do we mean by gradual? First, gradual is that we do not see the need, right, to undertake aggressive, heroically large rate hikes at each of our policy meetings. It doesn't fit with our economic circumstances. It doesn't fit with our conditions. Measured means that our policy decisions will be calibrated, okay, to take into account economic conditions and circumstances prevailing at the time. So if in our gradual process of normalizing policy we find, okay, that for whatever reason it is appropriate to pause, given the economic conditions at the time, measured relative to the economic conditions at the time, we will do so. If we feel at that point that it's important to hike more than usual, instead of 25, go to 50, we will do so likewise. Okay, so that's what's intended or meant by that statement in the MPC about gradual and measured approach. And it will be, again, the guideline for our policy normalization on the monetary front. And we've started to take first steps towards this. At our Financial Institutions Policy Committee meeting, again, which was held on 30th June, we started to withdraw some of the blanket measures, the FIDF fee and the dividend policy restrictions, which obviously leaving in place for a long time doesn't make good sense. And at the MPC meeting, the latest MPC meeting on the 10th of August, the committee voted 6-1 to hike policy rates by 25 basis points. And again, why 25 basis points? A question I get asked a lot is, well, why not do more, right? I think the rationale for hiking, I think, should be clear, right? Given the need for policy normalization. But, why not more? And to answer that question, I think we need to take a look and discuss a bit more about the outlook for the Thai economy and the risks associated with the Thai economy. First, on the outlook, it's quite clear, as indicated by the MPC statement as well, that the balance of risks in Thailand has shifted and changed. Before, right, the concern, most of the focus was on growth, right? Now we see that we feel more confident about the economic recovery, and the balance of risk and concern shifted more towards, obviously, inflation, as it has in many other countries. The first point to note is that we feel, with a good degree of confidence, that the economy recovery, slow as it has been, is intact and it's resilient. And we can see that in several ways. First off, if you look at the overall path of headline GDP, right? Last year we grew at 1.5%, very lackluster. This year we'll probably see something close to around 3. Next year something probably in excess of 4. So that is a recovery path. And if you look more closely this year, we see that first quarter numbers came out and second quarter numbers came out indicating that that recovery looks like it has been intact. Second quarter numbers, for reasons we can discuss, headlines might have appeared a bit more disappointing, but if you look underneath the headline numbers, what we do see, which has been quite encouraging, is that that recovery has been underpinned by strong domestic demand growth. Okay? Consumption has recovered really quite well. First quarter consumption came in at 3.5%. Second quarter consumption came in at close to 7%. Okay? Typically, pre-COVID, consumption was growing at about 3%. So it shows you that there's very strong consumption demand coming, private demand in the form of consumption coming back. And it's not just pent-up stuff. It's underpinned by real growth in incomes. If we look, for example, at growth in non-farm and farm incomes, it's registered double-digit growth for both the first and second quarters of this year. Right? So it's underpinned by real improvements in incomes, which reflects the fact that economic activity and whatnot is coming back. The number we track on the employment side is we look at the number of unemployed and underemployed, and those figures, again, have been trending lower and are well off the highs of under and underemployment that was reached during the worst of the COVID crisis. And very importantly, tourism. Okay, so in the past, we've seen that the recovery has been driven a lot by domestic demand and a gradual pickup in tourism, but going forward, we expect a big boost from the recovery in tourism. As you all know, tourism is absolutely essential, critical to our recovery in Thailand. Without a recovery in tourism, there will not be a recovery in the economy. Tourism is 12% of GDP, about 20% of employment, direct and indirect. So it's essential for the recovery in the economy. But on that front, again, there is positive news, and it gives us confidence that the recovery will be resilient. If we look pre-COVID, right, we had 40 million tourists a year. Last year, it went all the way down to 400,000. Okay. This year, year to date, we've seen about 3.2 million. And we've been upping our forecast, but we probably expect to see something north of 8 million tourists a year. Now, each million, this is important because each million tourists adds, in terms of gross spending, ballpark about 40 basis points of GDP. So the other thing that's important to note, again, I think is and it gets back to the point about how the recovery is resilient, is because we feel that the recovery in tourism will persist not regardless, but even though there are concerns about the recovery in the global economy. If we look, for example, in the past, bilateral tourist flows are relatively resilient to economic conditions, meaning that even if the source country of the tourists, the economy is not doing it, people still come here to travel. And it partly reflects, I think, the fact that there's a lot of pent-up demand. It reflects the fact that we are a cost-effective, value-for-money destination. But we feel, again, that recovery in tourism is likely to persist. It's likely to be very resilient, even though, again, the global economic outlook might be softening, as has been raised in several quarters. So, again, that gives us a fair bit of confidence that the recovery is both intact and resilient. The other point that was noted in the MPC statement quite clearly is that inflation will remain high this year, uncomfortably high, well above our target range. Our target range for headline inflation is 1% to 3%. It's been tracking at well over 7%, and this year, full year, we'll probably see something north of 6% in terms of inflation. But again, if we look at the path of inflation, okay, we expect inflation to peak in third quarter and then gradually come back into our target range sometime in the middle of next year. Okay. And that again reflects the fact that most of our inflation, which I'll go to in a bit more detail later, it's really been driven by supply side factors, almost exclusively by supply side factors, and concentrated largely in the food and energy space. There hasn't been, let me emphasize it, has not been any signs of demand side inflationary pressure, unlike what we see in the US and in the UK and other kinds of industrial economies. So the inflation, yes, very high, but again, trending back, barring again additional or repeated supply shocks, should come back within our target range within next year. The thing that does give us concern, and I want to emphasize, we're not sanguine about inflation. Like any central banker, I am paid to worry about inflation. In fact, it's in our legal mandate, so I am legally required to worry about inflation. But again, on the path of headline inflation, we feel quite comfortable that that's coming down. The thing that does give us pause and concern and has motivated the MPC to undertake the normalization cycle is we see core inflation has been trending up. We see core inflation, month-on-month core inflation has increased for 4 consecutive months, which gives you a sign or indication that that inflation engine that we don't want to kind of get fully started is picking up. And if that we don't take actions, then there's a danger and a risk that we will move from a low inflation regime to a high inflation regime. And the last point is on financial stability, which overall, as you know, is quite sound in Thailand. The buffers are very solid, bank capital ratios, liquidity, all that stuff looks very good. NPLs are not that high, but there are some vulnerable segments, again, given the uneven nature of the recovery. So some pockets, particularly in the SME sectors and the SMEs in the sectors that are lagging behind the recovery, and low-income households, which again is the reason why we need to leave some of these more targeted measures to address the vulnerable groups in place. So that's the overall outlook. And what about risk? Okay, what kinds of things should we be really worried about? There's a lot of noise out right there now about, you know, this is a risk and that is a risk, and I don't doubt that all those things are valid concerns, but we need to be able to prioritize and address, you know, which things are the things that we really, really should be concerned about, okay, and which things are probably less of a concern. First point, and I like to spend a little bit of time on this, is that we're not really worried that we're behind the curve, okay, and I want to emphasize this point, that we do not think, okay, that we are behind the curve in our normalization process, and there are a bunch of reasons for that. First off is that our economic recovery, okay, looked at in terms of the level of GDP, is still not at pre-COVID levels. This gets back to that point that I was trying to emphasize, that the economic context here is different from what it is in the industrial economies. We are at a different part of the economic cycle, okay? And just to give you a clear picture of that, and I try to avoid doing too many slides, but this one is, I think, a useful one. And if you take a look at what this chart shows is where a country's GDP was relative to its level pre-COVID when they undertook their first rate hike, okay? So that bar, okay, indicates the level of GDP relative to pre-COVID when each country in that list undertook their first rate hike. So if you look, right, all the countries that in this group, right, with the exception of Thailand, right, only started to hike when the economy reached or exceeded pre-COVID levels, okay? We started hiking before, right, on August 10th, before we reached pre-COVID. So again, if you looked at that way, it does not look like we are behind the curve. And compared to these other countries, we don't look like we are behind the curve. And again, that reflects, again, our particular set of economic circumstances. But aside from the fact that our recovery is still not at pre-COVID levels, If you look also at the inflation picture in Thailand, it's also different from what we see in a lot of the industrial economies where they are undertaking more aggressive rate hikes. In Thailand, as I mentioned, we see no signs of demand-side inflationary pressure. It's, again, all supply side, mostly concentrated in the food and energy space. Inflation expectations still look like they're anchored. If you look at surveys and things that we can back out from market prices, particularly on long-term inflation expectations, look like they're still anchored, look like they're still within our target range of below our target range of 1 to 3%. And also the concerns that have been raised recently about the baht is depreciating, and therefore there's going to be this high impact on headline inflation. Again, that story, yes, it sounds good, but it's not borne out by the facts. Exchange rate pass-through on terms of headline inflation in Thailand have been extremely low. Each 1% depreciation in exchange rate in the past has accounted for about 6 odd basis points in headline inflation. So it has not traditionally been a major source of inflation. It's very different from the context that we see in Latin America. So, and very importantly, there is low likelihood of a wage price spiral in Thailand. Okay, if we want to get that shift from a low inflation regime to a high inflation regime, that inflation engine's got to start. Okay, and barring like repeated supply shocks, right, which I think most of you would agree is not that likely, that we keep getting again and again and again these supply shocks. Barring that, the thing that would allow that inflation engine, the thing that's needed to get that inflation engine going, is a wage price spiral, right? Prices rise, the workers, get that in, they demand higher wages, and that feeds back in and it gets that inflation spiral going. Barring a wage price spiral, it's not that easy to get a shift from a low inflation regime to a high inflation regime. And in Thailand, again, there are a bunch of reasons to believe why the chances of a wage price spiral are relatively low. Okay. First off, our labor market is still has some slack in there. Again, given the high levels of relatively high levels of unemployment, underemployment, when again not back to anything near or resembling full employment, given the slower recovery in tourism that we mentioned. Secondly, if you look at the structure of our labor market, ballpark. Almost half, I think it's about 45%, but close to half of our workers are self-employed. So they're not wage workers. So the transmission, again, from higher wages to higher inflation is likely to be less, again, given the fact that a lot of people in Thailand don't even earn a wage. They're self-employed. They're farmers, taxi drivers, merchants, and vendors. Third, if you look at labor costs overall, they account for about a relatively small share, about 15% of total production costs. So that, again, the transmission from higher wages to production, higher and producer prices is perhaps not as strong as it would be in the more advanced economies. Lastly, if you look again, the level of the degree of unionization is low in Thailand. The degree of wage indexation is also extremely low. So it's a very different context than we would find in other countries, say like in Latin America or in the developed economies, which argue again for the fact that the chances of getting a wage price spiral in Thailand are low. So taken all together, again, I would argue like that we are not behind the curve, and that again, undertaking a gradual and measured approach towards normalization makes good sense for us, given our economic circumstances. Second risk that people talk about a lot is the Fed is tightening, right? And that poses great risks to our recovery. Again, yes, it is a risk. Yes, it is a concern, but is it the top of mind concern, the kind of thing that keeps me up most at night? The short answer is no. And why is that? There is this what I call a story floating around out there, right? A narrative out there, which is, the Fed has been hiking aggressively. Thailand has not. There's this widening interest rate differential. That interest rate differential has caused capital outflows from Thailand, and that has caused the baht to depreciate. Okay. It's a nice story. It sounds like it makes good sense, but it is a false narrative. It is not borne out by the facts in the case of Thailand. Why? First and foremost, the depreciation of the baht, like with many other Asian currencies, has been driven first and foremost by what happens with the dollar. It's been, when this year to date, we've seen the dollar appreciate by about 13%. The baht is depreciated by about 8%, more than Malaysia, less than the Philippines. But the movements in the baht have been largely reflective of what's been happening with the dollar, more than what's been happening with capital inflows or outflows. Second point is, there have not been, right, there have not been large capital outflows out of Thailand. We have not seen any untoward capital outflows. Year to date, in fact, we have seen net inflows of about 4.8 billion in bond and equity markets. So that story about the interest rate differential, capital outflow, it's not borne out by the facts. And if you look again of the 8 months this year, there have only been 3 months where we've had capital outflows. So there's some periods, I don't doubt that there have been outflows, but again, on net, it's not a huge story about capital outflows going out of the country. And even if there were, again, contrary to fact, even if there were capital outflows, the impact on Thailand is not going to likely be that large for the usual reasons that you're probably familiar with. Our external vulnerability is very low. Our buffers are very strong. External debt is low. Our reserves are high, right? And our ability to withstand those kinds of capital outflows, were they to occur, is quite substantial. So, and the kind of other kinds of risks that people talk about, from Fed tightening, Fed tightens, bond yields go up, and yes, that causes financial conditions in Thailand to tighten. That story also is not that, in terms of top of mind risk, not that worrisome. Why? Yes, if we see that Fed starts to tighten, we see bond yields in the US go up, we see bond yields in Thailand go up. The 10-year US yields and 10-year Thai yields tend to track, for example, very closely. But if you think about what happens to the real economy, how that gets transmitted to the real economy, what risk and what dangers does that pose? The short answer is not a whole lot. And why is that? First, it's because we are overwhelmingly a bank-based economy, okay? 75% of total financing is done through the banks. So the people that rely on the bond markets are, again, in the public sector, the government obviously, but the larger corporates. And their balance sheets are relatively strong, quite solid, so their vulnerability to these higher bond yields is quite limited. And if you look also at bank financing, our banks rely mostly, overwhelmingly, I believe the figure is ballpark, about close to 90% of the financing is from deposits. It's not wholesale funding, so it's not like they rely on bond markets to raise their financing, and that they would be affected by higher bond yields and would have to pass that through onto the real economy. So for those reasons, again, I think taken together, it shows you that again, it has to be a concern. Obviously, we look at it, take into account what the Fed and other advanced economies are doing. But in terms of risks to our recovery, in terms of the danger of it derailing that smooth takeoff, that one less of a top of mind concern. Third thing that we hear quite a bit about is low stagflation, the risks of stagflation. Right, global economy slowing down. Inflation here is high. Is Thailand going to see stagflation? And again, I would argue that in Thailand, the risks of stagflation are relatively low. Why? To get stagflation, you need high inflation. Yes, we see that. But again, as I mentioned, the path of it is likely to come down, barring additional supply shocks. And very importantly, our GDP, our economic recovery, is likely to be resilient, because a lot of it's going to be driven by the recovery in tourism, which, as we discussed, is not likely to be that sensitive to the slowdown in the global economy. And again, that's not any kind of magic of forecasting on our side. It's just driven mostly by math. Meaning what? Meaning that we went from 40 million tourists to 400,000, right? Any way you look at it, regardless of the global economic outlook, that number is going to come up, right? And it's already come up to 3.2 million. Okay, and again, our own forecast was probably see something north of 8, but it's coming off such an extremely low base, and as we've seen around the world, there's a lot of pent-up demand for travel, and so we think that helps provide greater confidence in our recovery driven by tourism and the resilience of the growth outlook. I am running out of time. The key risk, as you can probably note from what I've been saying, has related to tourism, right? That tourism, that's the thing that worries me the most, that if something were to impact that tourism recovery, because like so much of our recovery is tied to tourism, so that really is the key risk. And again, you know, nobody knows what's going to happen, but if there were to be some geopolitical tail risk, if there were to be some kind of new virulent strain that emerges and whatnot, then yeah, that would be a big concern, and the outlook obviously and the risk, the balance of risk would certainly shift. So by way of recap and conclusion, again, aggressive rate hikes and rapid normalization might make sense in some countries, but the right policy response is country specific and should reflect, right, the nature of inflation in the country, the cyclical position of the country, where you are in the economic cycle, and it should reflect the structural features of the economy. And in the Thai context, you look at it, right, our inflation is mostly supply side driven, no demand side pressures that we can see of. Our cyclical, where we are in the cycle, is relatively early in the recovery. Right? As I mentioned, we started hiking even before we've reached pre-COVID levels. And the structural feature of the economies suggest again that the likelihood of a wage price spiral is relatively low. And for that reason, we feel that the proper policy response in terms of normalizing policy, both on the monetary side and on the financial policy side, is to take a gradual and measured approach. So thank you very much.
Thank you very much, Dr. Sethaput, for your very insightful session.